Welcome to our Net Group Investment Quarterly Briefing, where we profile some of the interesting takeouts from our recent fund manager workshop with our local best-of-breed managers. To hear the full fund manager presentations or for more information about our funds, visit the Net Group Investments website or access more of our content via LinkedIn, YouTube, or podcast channels. In this episode, we review what happened in the global and local fixed income market and what could happen in 2024. We listen to a 2024 asset class outlook from a multi-asset portfolio manager. We examine which SA sector might perform best this year. What are the chances for SA listed property after a strong Q4 last year? Changing our focus, we talk about the outlook of Japan and China as the two economies diverge. Ending the episode, we talk about the geopolitical risks that come with 2024 and what they mean for your portfolio. Lara Dalmeyer, Portfolio Manager of Net Group Investments Flexible Income Fund, gives us a summary of how fixed income markets played out both locally and globally in 2023 and what lies ahead for 2024.
Now, just to take you through what we are seeing in the market, I'm going to start with a bit what's happening globally, just to give you a global backdrop, and then I will hone in on what we're seeing happening locally in fixed income markets. So the last quarter of the year, as I mentioned, the markets, global financial markets experienced a nice risk-on rally, and that was largely precipitated by the markets thinking that central banks are finally going to pivot, as in the hikes and the kind of more hawkish tone that we've been hearing from developed market central banks are going to come to an end, and that we are likely going to be seeing cuts happening this year. So markets got very excited after in October the unemployment numbers were slightly higher, the inflation numbers coming out were slightly more moderated relative to expectations, and markets started to think that this is a great environment for central banks to start changing their tone. And we did then experience this massive rally from the end of October, down November, down to December. You can just see yields across the yield curve rallying significantly. What's interesting is that not only did this happen with US markets, but markets were also pricing that cuts were going to happen from the ECB as well as the Bank of England. And this was all being priced to happen in the early part of the year. Come the Fed meeting, the FOMC in December, this kind of solidified the market's narrative where they came out a lot more dovish than what we've previously heard and cemented this rally strongly into year end. So the chart that I've shown you here is the FOMC dot plot. So it is what the members of the FOMC essentially project as being the rates up at the end of every single year. And if you compare what they were projecting in their September meeting to the December meeting, you can see just how much lower they actually thought rates were going to move in 2024. So they actually signaled that rates would be 75 points lower at the end of 2024 in the December meeting than what they'd previously thought in their September meetings. If you also listen to Powell's tone, he made mention of the fact that they are now considering cuts, which is a very different narrative than what we've heard previously. And he also cautioned against tightening for too long and that there could be kind of severe economic long-term effects if they keep doing that. So certainly a lot more dovish than what we've heard in any of the other previous meetings. But we have to take a step back. So yes, they are starting to talk more towards this pivot that everyone's gotten very excited about. But inflation, which is naturally the most important component of their mandate, is still a problem. This is the US inflation numbers. This shows you headline inflation. And more importantly, what they would focus on is core inflation, because that excludes more volatile elements like energy and food. Core inflation in the US is still sitting at 4%, way above target. So yes, the numbers looked like they were edging more towards a dovish narrative. It is definitely the case that markets got a little bit ahead of themselves in what they were pricing, because it's very difficult for the banks to move aggressively on a cutting cycle if this is still where inflation is sitting. And concerningly, it is still that US services ex-shelter component that is very related to the labor market that is showing excess stickiness. So there is still quite significant inflationary concerns that we are seeing. And we believe that we might be in this environment where it's very, very hard for inflation to move back down to the target for a significant period of time. If you look back and you try to see why has inflation become a problem, yes, there were supply chain problems, around COVID, but a very large driver of inflation, in our opinion, has been because markets have just been flooded with liquidity. And that was largely being done off the Fed's QE program and other central banks' QE programs. So the Fed has started tightening. They have started what we call quantitative tightening, which means that they drain liquidity from the market. And that naturally should counteract a lot of the inflationary impact that we've seen. But the Treasury is making the Fed's job exceptionally hard. Why? Because they are injecting liquidity into the economy. So if you look at the net effect, which would be looking at what's happening to the Fed's balance sheet, what's happening to the Treasury's general account, and what's happening in the reverse repo market operations. If you look at overall US liquidity, it is running very, very sideways. And in our opinion, this makes it very, very hard for inflation to remain under control for an extended period of time. So what's now happening on the local front, now that we've kind of seen what's happening in the offshore markets? On the local front, it is very likely that hikes are finished, but it is also very likely that we are not going to be seeing this deep cutting cycle in local markets. Our base rates are probably not high enough. We have a neutral rate, which is probably needing to be pushed a bit higher around fiscal concerns. And although we don't have an inflation problem, there are a number of forecasts that suggest that inflation is not going to easily reach the midpoint of the target band. There is a case to be made that, as we kind of see this fiscal deterioration and bigger inefficiencies in the economy, that inefficiencies lead to inflation. The cost of business is very high. So overall, the risks to inflation are on the upside. So given all these kind of reasons, it is hard to see a very deep cutting cycle happening locally. But having said that, naturally a cutting cycle will come, but in all likelihood it will lag what's happening in the developed world, and in all likelihood it won't be this very big cutting cycle, which likely won't provide the relief that I think many are hoping for.
Omri Thomas, Portfolio Manager of Net Group Investments Opportunity Fund, gives us his asset class outlook for 2024.
So just our outlook on the asset classes, starting on the expensive side, we think US equities continue to look expensive, especially the sort of Magnificent Seven, if we can call it that. I mean, that drove most of the returns on the S&P last year. Developed market bonds, ex the US, still look expensive. US bonds have moved from the expensive bucket into the fair bucket. And as I said, we've added to that exposure. Developed market equities outside the US also looking attractive. We think the Rand is sort of in a fair value range, probably slightly undervalued with fundamental reasons for it being there. And in global cash, also fair. We think SA bonds, SA equities, SA cash, and emerging market equities looking attractive. So having a higher local exposure, again, that is where we see the value.
Saul Miller explains his positive outlook on SA financials for the year 2024.
With that, let me start with one of the SA equity sectors that we like and where we have a reasonable position, and that would be financials. And that really talks to the very high dividend yields in SA financials. You've got shares like Absa on a dividend yield of over 10, Investec with a dividend yield of over 7.5. The reason why we like financials isn't just that the dividend yields are high, but we think those dividend yields are dependable. In other words, we think that you can get growth in those dividends. However modest that may be, there will at least be some growth in those dividends over time, which should give nice teens returns to the portfolio.
The SA-listed property sector outperformed all other sectors in the fourth quarter of 2023. Ian Anderson, who manages the Net Group Investments Property Fund, reveals his current strategy for the year ahead.
In terms of current fund positioning, not much has changed here. We have reduced our exposure to South Africa. I think the last time that I communicated with the marketplace, we were sitting at close to 78% South African exposure. We have got a little bit more constructive on Eastern Europe and specifically NEPI in Eastern Europe, but we are still very nervous about the fact that many of those businesses need to refinance a massive amount of debt that was taken out when interest rates were at 1% and 2%. If that debt was to be refinanced today, the interest that would be charged on it would be closer to 5% and 6%, and that has a meaningful impact and negative impact on the cash flows of many of these businesses. Within South Africa, where we do have the bulk of our exposure, we do prefer the Western Cape. We have significant exposure to the Western Cape through businesses like Spear, and we have very little exposure, or as little as we can get, to Gauteng and especially Sandton offices being our least preferred sector at the moment. In terms of property type exposure, we continue to favor convenience and neighborhood retail. So we are underweight retail in totality. The market weight is around 60% and we're under 50%. But the bulk of our retail exposure is to convenience and neighborhood shopping centers, mainly in rural areas and townships, where we continue to see very strong footfall and very strong increases in turnover for tenants, which should translate into higher rentals down the line. In complete contrast to that, the market exposure for retail is predominantly in very, very large shopping centers where there continues to still be a significant amount of strain. The one area where we have reduced exposure, and it wasn't something that we did intentionally, but as a result of corporate action, our residential and self-storage exposure has gone from around 19% to just under 12%, and that was as a result of SA Corporate's acquisition of Inlu Place. We do own SA Corporate, and so we haven't lost all of that exposure, but as I've mentioned, it has reduced from around 19% to 12%. We did incredibly well out of that position over the last year, as SA Corporate's, the price that SA Corporate paid was around 30 to 40% above where the market price was at the time of the announcement.
Saul Miller compares the different prospects of Japan and China, two of the world's largest economies.
Japan is one of the reasons where we see some positive tailwinds, both cyclically and structurally. What we've seen from the Tokyo Stock Exchange is they've introduced some reforms requiring companies to submit plans to improve their capital efficiency, which should be good for their returns on equity and will hopefully drive the prices for a number of Japanese companies to at least exceed their book values, which would also be hugely positive for the Japanese market. We've also seen wage increases as a result of COVID inflation. So we're seeing these wage increases after many decades of fairly stagnant wage growth, which could also be quite positive for the economy. Japan is one of the few developed economies that actually has positively sloped yield curves. In other words, you've got a bit of inflation and they are still keeping interest rates low and they're keeping monetary policy quite stimulative, which should be good for the economy. And then finally, valuations in Japan are certainly in reasonable territory if we look at them relative to their long-term history. Moving on to China. Things are still fairly uncertain in China. One of the key problems is obviously around consumer confidence, which continues to remain very depressed. We're seeing savings continue to grow for the Chinese consumer. Some of the key reasons for that concern from consumers obviously relates to falling property prices. That is a key source of wealth for Chinese consumers. There is still a tremendous amount of regulatory and geopolitical risk in China. We still have deflation in China, and there really hasn't been any significant stimulus. So we've seen incremental pieces of stimulus coming through over the last year, but certainly nothing significant enough to galvanize consumers into spending. So valuations in China are optically cheap. In other words, they look low relative to their own history, and they're certainly low relative to other offshore countries. However, what's difficult to determine is what a fair risk premium or a fair valuation for Chinese equity markets would be. So given all of this, we still have some exposure to China, but it is quite modest.
Rashad Tayyab warns us about the geopolitical challenges that we as investors need to pay attention to in 2024 and how they affect our investments.
Now, over the last 10, 15, even 20 years, geopolitics and politics in general has been something that the market has been always been able to ignore. Regardless of wars, of terrorist attacks, whenever there was a dip in the market caused by politics, it made sense to buy, and you saw the markets rebounded very quickly. But if you look at some of the geopolitical risks that are building going into 2024, you're seeing the relative position of the US diminish. The US has been the major economic and military power since World War II. Its position is now coming into question. You've got war in Europe, and you've got China asserting itself as an economic power and also a military power in the East. And things are getting a bit messy. You're getting a period of deglobalization, which we think is very real, and therefore geopolitics is not necessarily something that you want to be ignored going forward. And the important thing about deglobalization is that it impacts your portfolio in two ways. Firstly, globalization has been very good in terms of having low inflation, open borders, open trade. It's been a deflationary effect on the world, with China the biggest manufacturer exporting deflation globally. If that goes into reverse, I think this very benign 2 decades of inflation environment will begin to come into question. You have to run with a bit more stickier inflation going forward. And then secondly, if you starting to put up trade barriers, if you're starting to sanction countries, then your potential growth of the world then comes down. And we have to be aware of these two impacts on growth as well as inflation can be negative for asset prices going forward.
You can access more information about all the fund manager workshops at Net Group Investments website, YouTube, or through our podcast channels on all major platforms. This has been your Net Group Investments quarterly briefing. Make sure to check back at the end of April 2024 for our next edition.